Welcome back to Proper Wealth with me, Paul Mahoney. Today we're going to be talking about property versus shares, an age-old question with a slightly new take. And joining me today is Stefan Vadamootoo from Nova Financial. Thanks for joining me, Stefan. So Stefan, when it comes to building an investable asset base, people obviously have a range of options. And I suppose the three broad options are property, shares and interest-bearing investments, and a range of things that might fit in within that category.
Yeah.
So can you talk to me a bit about those options and potentially who they might suit?
Yep, of course. Look, there are those three options. We don't like to consider commodities as an investment per se for wealth creators, and the reason that is because things like gold and silver don't pay an income stream. What they do is it's more of a speculation essentially. So when you do consider shares, property and interest-bearing securities, there seems to be a lot of options when you think about the investment landscape, but it really does come down to those three. Now, I think the question is what a particular person's situation is. It really does depend on which asset class they go to or they should be invested in. I mean, ideally, for people that are in their pension phase, we want to be seeing a good mixture between those three assets. But during the wealth creation phase, there are some that we prefer for people or for clients. And for myself included in that, I've been investing. I bought my first share when I was 11 years old. Now, it did actually lose money, but I've been hooked ever since. And I've been advising for my whole professional career in the space of shares, property and interest-based securities.
Okay, right. So if we start with returns, and talk about the returns of property and shares over the past 10 or 20 years, what have they been like in comparison to each other?
Yeah, no, it's a really good question, and it really does depend on whether we're talking about cash portfolios or we are using leverage.
Okay, well, let's start with cash.
Yeah, absolutely. So generally speaking, over the past 10 or 20 years, the returns from shares and property have been around the same. You know, in some cases you have property being a little bit better. I think in the last 10 years, property has done 90% cash portfolio, and shares have done 70 odd percent, which is much of a muchness when you consider the cash portfolio for those two assets.
Okay. All right, so that's as a cash buy. That's if someone's actually going out and buying those assets solely with cash. What if you include leverage, so far as actually taking a mortgage or a margin loan when it comes to investing in those two options?
Yeah. Well, look, I think going back to that point of cash portfolios across those two assets, though, Paul, is rarely do we come across people that can just go out and spend, you know, a few £1,000,000 on a property portfolio. So there is a requirement for a lot of people to use leverage. Now, across shares and property, the discussion surrounding leverage greatly differs. And it really comes down to what interest rate you can pay, you know, on those types of investments. Shares, you're looking to pay a much higher interest rate to invest in a portfolio of shares. When it comes to real estate or property, you can be invested with a much lower interest rate and a much higher LVR, or loan-to-value ratio, as we call it.
I suppose it's slightly cheaper to borrow to invest in property, and you're able to borrow more money. So therefore, able to leverage your funds more and potentially multiply your returns more.
Correct. Now, it's certainly not a penalty that you do have to pay a high interest rate to invest in shares, but it's really the perception of the lender perceiving shares as a more risky investment relative to real estate, and that's obviously because of the volatility associated with shares relative to property investment.
And from a returns perspective, so far as how property performs with leverage and compared to shares with leverage, what are the differences there?
Well, look, as we discussed earlier, the overall, on a cash purchase, you have, generally speaking, the same sort of returns. Now, if we break returns into two different parts, being one capital appreciation and the other being income, generally speaking, you can expect capital appreciation across shares and property to be around 5 to 6%. And when you're talking about income, you're talking about rents and dividends, you can also expect, you know, 4 to 5% on your portfolio. Now, essentially what leverage does to those returns is it increases them. You know, if you have your £50,000, you can go out and invest in that cash portfolio and get, again, what we talked about, you know, a 6 to 10% return on your cash portfolio. Or you can go out and leverage that, you know, 75% loan to value ratio with real estate, purchase a £200,000 property, and get that return, the 4 to 5% yield, rent, or the 5 to 6% capital appreciation on the entire assets. So a much greater return on your applied capital.
So I suppose the differentiating factor when it comes to property and shares is really the ability for leverage.
Well, yeah, exactly. Well, I think it's the major difference. I mean, it is the major consideration when any investor goes to say, look, generally speaking, a mum and dad investor will say, well, how are we going to retire? What are we going to use in our retirement as income? I mean, when you consider both shares and property, I think it's the major difference between the two. And it's the main consideration that any investor should have when approaching the market, when they're talking about building an asset base.
Okay, Stefan, so talking about the ability to leverage property, lower interest rates, high loan to values, more stable, compared with the shares potentially less stable, higher interest rates and lower loan to values. How can a mum and dad investor, an average investor as opposed to a professional investor, utilise that strategy to improve their financial position?
Yeah, it's a really good question. Well, when we come across mum and dad investors, we generally find that they have some equity in their home, which they've built up over time, or even they might have a small pot of cash. They can, draw out £25,000 out of their home equity, and then leverage that asset and buy a £100,000 property, and again get the returns on that £100,000 versus say if they drew that equity out with £25,000 out to buy some shares, they'd be getting a return on that 25,000. And the reasons why they wouldn't leverage on that 25,000 is because the interest rates are much higher. At the moment, they're actually beyond the average dividend yield that you'd be getting from a portfolio of shares. And so you really do have to get amazing returns when it comes to your share portfolio if you're going to match the ability to grow wealth similar to real estate and property.
Okay, so given that we're in a historically low interest rate environment, the basic rate at the moment is 0.25%, and therefore when it comes to investing in property, you can borrow at 2 or 3% for a 75% loan to value. I suppose what that means is you don't necessarily need to set the world on fire with regards to your rental return or your capital growth to still do quite well.
Yeah.
Would you say that's the case?
Oh, absolutely. I mean, there's a huge disparity between the interest rate that you'd be paying at the moment and the returns that you can get. I would say, though, with caution, that everyone that is considering a leveraged portfolio into property is appropriately doing their sensitivity analysis. Because at the moment, as you mentioned, Paul, the interest rates are historically low. If they do creep up, we want to be making sure that people that are investing in this way are going to still be able to maintain their portfolios, because as you know, it's time in the market versus timing of the market when it comes to this.
I suppose it is probably quite likely that rates will rise over the coming years. So I completely agree. Stress testing the portfolio, which is becoming a hot topic in the buy-to-let market at the moment, isn't it?
Absolutely, yeah.
So far as stress testing, most buy-to-let lenders at the moment are using rates of 5.5% for stress testing. So making sure that works. Okay, that's all very good. So we're talking about leverage for property being more stable, better ability to utilise your money.
Yeah.
So far as the actual markets themselves and their stability, so property versus shares and the stability overall, how do they tend to differ?
Well, they differ greatly. There's no question about it. The fact that you can readily access or sell shares or buy shares also leads to the reason why it does have a lot of volatility. Volatility is essentially the risk associated with that investment. You can have something that's not even related to the company that you've invested in, and you can have your shares go down or your portfolio go down.
Okay, so we've talked about there so far as the ability for leverage with property versus shares, and it seems the overall running theme is that property gives a bit more ability to leverage your money at cheaper rates and over a longer term potentially. So far as stability goes though, obviously people want to make sure that their money's safe and that their investments are stable. How do the two markets compare to each other?
Well, they do differ greatly, Paul. Shares are quite volatile. In 2008 is a really good example of the differences between shares and property. In 2008, we saw the FTSE All Share Index drop by 32%. And the property sector actually dropped 8% in the same year. And the reason that is because when people hear about an economic downturn across in China, They don't necessarily sell their property, but they may sell part of their share portfolio, which can have an overall effect on the long-term returns that you're getting from your portfolio.
And I suppose waking up in the morning and seeing that your share portfolio has fallen by 30% would be quite a fright.
Yeah, well, exactly right. And usually, unfortunately, what happens in those instances is people, when they have a large asset base and it's their retirement bucket, let's call it, they don't really think rationally. And unfortunately, what you have is people sell at those times. Even if you saw that the property market was going to be going flat or maybe dipping, you're still receiving your rent from that property. The transactional costs associated with real estate are much more significant, stamp duty, real estate costs and stuff like that. You're less inclined to go, oh, actually, let's just sell out quickly. And even if you did that, property does take time to sell. It is quite a liquid, which I think is a positive more so than a negative when you're building a long-term asset base.
Yeah, it's a good point, actually. I suppose some people would perceive that as a negative because you can't sell property in a whim and have your money back within a few days like you can with shares. But that obviously results in more stability.
Yeah, exactly right.
So I suppose the share market is more impacted by perception.
Yeah, absolutely.
And I suppose psychology of investors, as opposed to the property market, which moves a bit more slowly and doesn't tend to move on a whim. Would you say that's right?
Yeah, absolutely. I mean, the psychological outcomes across both investment classes are huge.
Yeah.
If there was a ticker in every single letterbox out there in every property, it would be a different story because people could buy and sell their real estate whenever they wanted to. Yes. Or, for owner-occupiers, if they didn't want to live there anymore, they could go, okay, sell. So you would have a more volatile market there, but it's simply not the case.
Yeah, okay. And so far as that investor psychology that we've just spoken about there, how that impacts the share market and the property market, how much do you think that comes into play, and how can people, I suppose, perceive that to their advantage?
Yeah. Look, it's a huge factor. I mean, we've already talked about when markets go down, or, when it comes to shares. And it's not just selling investments because you're losing money or you're making money. When it comes to shares, we rarely see people building up a large portfolio over time, versus property. We do see that. And the reason that is because mum and dad investors say they want to do a renovation on their bathroom or their kitchen, and they need some capital. Now, versus going to the bank and getting leverage or equity out of their home to do that, they can readily sell some shares and inject that into their personal circumstances. So that psychology does play a factor immensely when it comes to both asset classes. You can't sell a bathroom in one of your properties or a bedroom in another one to inject capital into your personal circumstances.
So I suppose sometimes people are their own worst enemies.
Oh, absolutely.
Whether they need that money for general living expenses, or as we said before, if the value falls significantly and they get frightened, and perhaps they might sell at the worst possible time.
Yeah.
Whereas I suppose in general, when it comes to property, so long as your property's rented, you're not all that too concerned with the value.
No, absolutely.
Because you can see that bad time out.
Yeah, absolutely. I mean, for myself, when I've seen one of my shareholdings, increase in value and I sell, I see that money in my bank account, and I was like, okay, I think to myself, well, I might dip in there and buy something. It's as simple as that psychology that stops people from being able to accumulate a very large portfolio from nothing. And that's why, generally speaking, we do favour real estate as an investment.
I suppose that's the other side to it, is when people see their shares increase in value quite a lot, and they see they've made a profit, where they might be leaving quite a lot on the table, by selling out. Whereas I suppose with property, people view it as a more long-term investment, perhaps because of the entry and exit costs that we spoke about. But I suppose generally that people just need somewhere to live, don't they? So if you're invested in the right areas, then I suppose the demand will continue.
Yeah, that's correct. I mean, people live in their own properties for years and years and years. It's the same attitude when investing. Nobody goes out and buys a property, well, I hope they don't, goes out and buys a property to only sell it in a few months' time or in a year's time. Generally speaking, when people are making that decision to invest in property, they're doing so with a 7 to 10 year time horizon on that investment. So you can really get the benefits of growth over the long term.
Okay, Stefan, so what sort of investment time frame would you say is recommended for when investing in shares?
Well, I would say that it's a very similar time frame to property. If you're going to get the full benefit of holding a share portfolio over the long term, through the ebbs and the flows, we're looking at 7 to 10 years as well.
Quite similar.
Yeah, very much so.
Great. Well, thank you very much, Stefan. Very informative there. That's all we've got time for now. Thanks for joining us, and join us after the break for more. back to Proper Wealth with me, Paul Mahoney. Joining us today is Stefan Vadamootoo from Nova Financial. Thanks for joining us, Stefan. We're going to talk about wealth creation, where people are looking to build an asset base, versus the retirement phase of their life when people are looking to take advantage of their asset base. Following on from our previous discussion on property versus shares. So, Stefan, if we start with wealth creation, the types of investments, both property and shares, that might suit that type of person. Can we talk a bit about that?
Yeah, so following on from what we mentioned earlier, property versus shares and which one is the better asset for the wealth creator. When we're talking about wealth creators, we are really looking for a leverage strategy or using property with leverage to build up your assets. What we didn't talk about though is whether it's always going to be appropriate for people, that type of strategy, which it isn't. If for people that are near in retirement or in retirement, it probably doesn't make sense to be going out and taking on a lot of borrowings from the bank because there's no strong ability for them to pay that asset off.
Okay.
Does that make sense?
It does, yeah. So I suppose the prudent use of investment debt.
100%, yeah, correct.
I agree with that. I suppose with a lot of people, even if they save every penny that they earn, they may still not be on track to achieving their retirement goals and to be able to live comfortably.
Yeah.
And I suppose that figure differs for everyone, doesn't it?
Oh, 100%.
So far as what they need to be achieving. And I suppose what's quite important for them to understand is what that end goal might be.
Yeah, absolutely. I mean, people should always have a really good understanding of what they actually want to achieve in retirement before actually investing, which unfortunately the case is a lot of people don't have that plan in place.
Yeah. And I suppose a lot of people tend to go about their investment journey, if you like, in a rather ad hoc way, don't they?
Absolutely.
So if we're talking about wealth creation, and that's kind of what that investment journey might be, how can people put in place a bit more of a strategy? And I suppose between those two options we've been talking about, property and shares, what types of those types of investments suit that wealth creator, but I suppose tend to be more growth focused?
Yeah, absolutely. Well, I think to answer your first question is what they should be doing to set themselves up for retirement. I think the most important question is, when would they like to retire? Getting a good time frame of how many years until they retire. Because as you know, when you're talking about investments, especially these types of investments, we are getting our returns over the long term. So knowing when you're going to retire and then setting a plan in place to allow you to get there relative to your resources. Unfortunately, sometimes what we see is people get very close to retirement, think, okay, well, I'm not going to have enough, and then they make brash decisions or they invest in exotic investments, which is not generally it's not the best thing to do generally.
Yeah. And I suppose if somebody is starting out with a relatively small pot of money, and they're looking to go through that investment journey, create wealth, so at some point in the mid to distant future, they can retire. Would growth be most important for that type of person? And potentially income is more about supporting that leverage we've been talking about?
Yeah, absolutely. So when we talk about wealth creators, we are talking about people that are earning an income. So they have the money coming in to pay for their lifestyle, debt reduction in their home. And we are talking about investing for growth. So taking on some leverage and really having that income that they're getting to facilitate the allowance of growth or leverage to build up their portfolio. They don't necessarily need that wealth now. Hopefully they don't. It's really for tomorrow or 10 to 15 years down the track.
So I suppose focusing on, whether it be property or shares, focusing on assets that are going to grow in value so that they can best utilise that leverage we've been discussing and multiply their returns, build an asset base before they're looking to actually get the income from that asset base.
Oh, 100%. I would say that there's got to be a skewness towards real estate or property as an investment with the use of leverage during the wealth creation phase of a person's financial life.
And is that because of the better leverage or the returns or the stability, or a mixture of all three?
Well, it is a mixture of all three, but the main key is when you're talking about building up a large asset base, if you're talking about having a passive income of say £30,000, which is about the average what people would like to have for comfortable retirement, we're talking about £600,000 worth of investment assets. So to be able to generate that size of a portfolio...
On what sort of returns?
On a 5% return. So I like to use 5% because it's quite a low risk strategy for that portfolio. Once you reach retirement, that asset base becomes your livelihood. So you don't want to squander it. But also it counts for the unknown. You know, I don't have a crystal ball, Paul. In 15 or 20 years' time, who knows what the market's going to be able to offer us in terms of returns. So I do like to use 5%.
Okay, so we'll just recap on that. So someone who's looking to generate £30,000 of passive income at some point in the future, they should be looking to build an asset base of £600,000. I suppose that can be invested anywhere, you know, whether it be property, shares, or otherwise, so long as that's giving them a 5% yield.
Yeah, correct.
Okay, so that's the end goal. And I suppose once people have that end goal, they can then sort of reverse engineer that to determine how they're going to get there.
Well, that's right. You know, to build up that asset base, we've already talked about why real estate can assist in doing that in the most productive or effective manner. Once you reach retirement, however, it may make sense to include other investments such as shares and fixed income. Shares will provide the liquidity and fixed income will provide that certainty with returns and also the liquidity as well.
Okay, well, let's move on to that. So we've covered wealth creation, the fact that growth is probably the most important thing, the prudent use of investment debt is almost essential in most cases, and that potentially property is a better asset for doing that, given its stability, given its cheaper and longer term leverage, and also the returns that it generates. So that's the wealth creation side. Once people actually have that asset base, you know, the example we've used there, you know, let's say £600,000 they've got invested in something. What happens then? You know, is there a shift in focus?
Look, perhaps there may be a shift in focus. You know, I like to keep the skewness towards real estate or property whilst people are in their pension phase. It's for a number of reasons. One main one being the fact that you have to have longevity with that asset base. You know, people are actually going to be, some people are going to be in their retirement for the same amount of time they were in employment. You know, it could be 30, 40 years in retirement.
So I suppose people are living longer these days, aren't they? We don't really know how long we're going to live.
Absolutely right. So that money does have to last. So you want to be skewing your investment portfolio in favour of assets that are going to tread well or hedge well with inflation. Now, given the fact that inflation is made up largely of you know, for a large part, mortgages and rents, property is a good option when you want to be hedging well with.
That's a good point, actually, because I'd say a lot of people would probably have that sort of roundabout figure in their mind of what they might need, but then are potentially planning to just spend it. And I suppose if you have your 600,000 and you just start spending your 600,000, it's probably not going to last that long, is it? So making sure that pot, you know, that nest egg, is invested in something that will actually sustain its value with inflation, as you say, which, you know, I think at the moment is going close to 3%, so above what the aim of the Bank of England is, which really eats away at the value of that money, doesn't it?
Yeah, well, it does erode the capital that you've built up. So real estate is a good growth engine, as we've talked about, even with a cash portfolio. But you know, it's not necessarily the case that you need to sell down your properties that you had in the wealth creation phase and then buy different ones when you in your pension phase. If you've purchased the right types of properties, you've purchased them in blue chip markets around, you know, city centres and stuff like that, there's always going to be a strong yield for that property.
Okay, really important point there. So sustaining the value of your asset base. So far as what becomes most important there, so we spoke about wealth creators and the importance of growth, the importance of building an asset base. I suppose once people have that asset base, probably income becomes a bit more important, would you say?
Absolutely. There's no point having a portfolio of property worth £600,000 and you're only generating, you know, £10,000 to £15,000, which, you know, we do see a lot happening like that. You know, for people that have invested in London, they have a large property portfolio, which has a large value, but the income they're generating from it is circa 2 to 3%. So well under what we talked about earlier about that.
So asset rich, but income poor.
Income poor. So it may mean that an oscillation is required. So investing in, selling those properties or investments and moving more towards your income generation or income focused in terms of those returns that we talked about earlier, growth versus income, focusing more towards the income generation than the growth.
So, you know, for example, moving away from the likes of central London, high value, low yield, more so toward things that are going to get you a much higher yield.
Absolutely, yeah, correct.
And you know, you mentioned that could be through selling, that could be through diversifying, I suppose even through remortgaging to take some equity out and better balance your portfolio.
Yeah, correct. I mean, all those options are good.
Okay, thanks, Stefan. So we've spoken there about both the wealth creation and the retirement phase and what's most important to each of those people in each of those phases of life. I suppose moving on from that is, it's easy for us to sit here and talk about these things, but so that the average mum and dad investor can understand these things, what would you say is most important to help them through each of those phases?
Understanding their financial situation would be one. Understanding what, unfortunately the case is you can go to the bank and you can get a large amount of borrowings. It might not necessarily be the case that that's the best thing for you. So understanding what's appropriate for your situation is probably the most important thing that I would say, and seeking advice. It's not. It is extremely important that people are seeking advice with regards to their finances. We have a lot of people that think they can do it themselves, and some people can, absolutely. But there's no harm in going out and seeking some advice, getting someone else's opinion on your financial situation and what they believe is best for you.
I suppose understanding what your options are, because you don't know what you don't know, do you?
Yeah, and there's so much there's so many options out there. There's so many strategies. There's so many things that you can do. A lot of them are probably not appropriate for your circumstances, though. Relative to your own circumstances, only a few of them will be the best thing.
Yeah, and look, I'm a big believer in surrounding myself with people that are more intelligent than me, which isn't hard. But people that specialise in certain areas, and certainly seeking advice from a financial planner or a property advisor or an equities advisor, people actually know what they're talking about. Has helped me personally, certainly when it comes to making the right decisions.
Yeah, exactly.
Well, thank you very much for that, Stefan. Very informative. I'm sure our viewers have found a lot of value. That's all the time we have for now. Thanks for joining us on Proper Wealth. Join us next time for more discussions on wealth creation.